Hello, everyone. Can you hear me? Yes? Thank you. Well, good morning. Thank you for making it on time and finding the stage. That was the first challenge of the day. I'm Imen Marzi, and I'm very, very honored and happy to open this morning on a topic that is very key to my heart, which is the cooperation between public and private players when it comes to investing. So on stage with me, we have Françoise Lombard from P.O.E, and you can't hear me? You need to, oh. So everybody, to be able to hear me, you'll need to have the headsets, yes? Yes? Okay. So Françoise Lombard and I will be discussing for a little more than 15 minutes on the pressing issues and the trends and also the fundamental shifts that Françoise is observing. And unfortunately, we won't have too much time for questions from the audience, but I hope the conversation this morning will fuel your curiosity and hopefully get to interest you enough to stick around for the rest of the morning while you will have a time for networking. So we'll start with Françoise, and then we'll have a panel between private investors. The three of them will join me in a minute. And then a special duo who is very hard at work to support these cooperation and these acceleration of cooperation between private and public investors. So here we go. Françoise, good morning.
Good morning.
I will say just a couple of questions, and hopefully you will share with us your knowledge and expertise.
Yes, of course.
Thank you.
Delighted to be here.
Thank you. So P.O.E and its DFIs peers have contributed over the years to mobilize and help leverage significant amounts of public and private money in seemingly uninvestable projects. You deploy 2 billion euros per year. You have a total of 53 billion deployed. You have a target of €1 for one by the end of 2025 between public and private money. How do you see your mission evolving 10 years after the Paris Accords?
Thank you very much for your question. I will do my best with the mic and the noise behind me. Sorry if it's not clear. So, yeah, okay, thank you. So, development finance institutions have been on a journey over the last 10 years. And I want to highlight maybe three major changes. The first one is the growth of activity of development finance institutions. The Paris Agreement opened a new chapter in the story of development finance institutions because it allowed to increase quite significantly through climate finance the activity of development finance institutions. So climate finance has really been the main driver of the growth of activity of DFIs over the last 10 years. For instance, P.O.E.'s balance sheet has grown from €1 billion 10 years ago to almost €9 billion today. And beyond climate finance, DFIs have firmly anchored their action within the SDG framework over the last 10 years. Second thing is the emergence of blended finance. It's quite new. Just at the P.O.E.'s level, before 2019, we were not able to use concessional resources. So it's a new thing for us, and it has allowed development finance institutions to expand the scope of their action, taking more risks, being more active in fragile contexts. And of course, the COVID crisis, I think, has been an accelerator in that path, in that journey, because it highlighted the need for being more and more counter-cyclical. And after COVID crisis, the European Commission has taken a huge turn with a massive EFSD Plus guarantee program, allowing DFIs, European DFIs at least, to take more and more risks, benefiting from those guarantees. And third thing is private capital mobilization as a new paradigm. And it is new as well. Of course, it is due to two main factors. First one being the increasing volume of investment needed to ensure sustainable transition. And second one is, of course, the increasing constraints on public resources. So DFIs are expected to play a catalytic role, sharing their expertise, preparing more, high quality and bankable projects, and offering risk-sharing mechanisms to other private investors. At Proparco level, we have the ambition to reach a 1-to-1 ratio. That means for €1 on Proparco's balance sheet to mobilize €1 of private capital.
Thank you. So, do you see any French or European specificity when it comes to the practice of development finance? And perhaps can you share an example of how this specificity unfolds towards beneficiaries?
Yeah, thank you. It's really a very good question. I mean, how can we differentiate at the European level or at the French level? I will stay at the European level because I think it's more relevant. And if I have to insist on just one distinctive feature, I would say a real culture of partnership. I mean, in a context, in an environment where we have to be both catalytic, strategic, and where public money is scarce, team up is really crucial. And I think European development finance institutions have understood early the interests of joining forces. We have created, it was in 1992, the European DFIs Association, which is quite active, gathering 15 European DFIs, managing a portfolio of 53 billion euros. The CEOs of those DFIs, meet at least twice a year. Proparco will host the next annual general meeting of European DFIs in May in Paris. We are very glad of that. And we are discussing, both strategic issues, but also very business-oriented. And I want to say that not only we created this association, but we went further, creating a financial tool in common with a kind of small asset manager, fee management company, that is able to manage facilities on behalf of the European DFIs, but also to negotiate with the European Commission on behalf of DFI.
Excellent. So one of the common challenges mentioned by private players to invest in emerging or low-income countries is their perception of risk. I think we can all recognize that we're in a VUCA world with climate, geopolitical risks, social risks, uncertainties. So are there any lessons that private investors could draw from your long-standing practices of managing many stakeholders with the somewhat diverging agendas and risk perceptions? Or do you think that private investors should just stay the course and in spite of headwinds and financial pressure? What are your lessons?
Yeah, first of all, the risk perception is maybe a bit too high, but it's not groundless. We cannot say that. I mean, in fragile environments, ticket size is usually smaller. It's more difficult to disburse the funds, and the risk is higher. I mean, this is a reality, even if sometimes it's a bit exaggerated. So this is the first thing. So how do we invest? Because we want to invest in fragile environments, and this is our mission. For that, we have to develop dedicated approaches and dedicated tools, I think. First thing is the understanding of local context. It's crucial. We can rely on our presence on the ground, Proparco's presence, our mother company, AFD's presence. We sometimes have to go beyond just market understanding and developing an understanding of the conflict sensitivity for conflict-affected environments and its dynamics, both on a positive perspective, but also as a risk mitigation, of course. Second thing is, setting dedicated tools for that. We need more technical assistance for accompanying our clients in those fragile environments. We need also dedicated facilities. We have a fragile countries facility at Proparco. We have also developed for a number of years now a specific equity vehicle for that allows us to take more risks. So we have to really have dedicated tools to act efficiently. And once again, we have to partner. This is key. And I want to just touch upon one initiative that was founded at the inception by British International Investment and the Dutch Development Bank, FMO, and that Proparco's joined recently, which is ARIA, Africa Resilience Investment Accelerator, which is a new approach on prospecting in fragile countries for all the development finance institutions. We also partners with IFC, which is very active in fragile environments. We are partnering with the International Committee of the Red Cross. So partnership is really sharing intelligence on that context is really crucial. It's possible because, you know, Proparco last year invested 540 million euros in just fragile and conflict-affected situations and least developed countries, and just on the scope of fragile and conflict-affected countries, more than 300 million euros. So it's possible.
Thank you, Françoise. Just for the sake of time, I think we skip the fourth question and we'll go directly to the fifth. Private investors are more and more attracted to climate investments around the globe, and you mentioned the evolution of climate finance in your own portfolio. Yet more often than not, climate projects are analyzed through a carbon-only lens, at the expense of a more holistic, well-rounded approach. What about ecosystem dependencies? What about inclusion and equality at the beneficiary level, but also at the regional or national level? So can you share with us how Proparco catalyzes a wider definition of climate, which means including people and living systems, to encourage private co-investors to broaden their view of their impact?
Thank you. I think you're perfectly right in saying that the climate finance story started through mitigation. That's true. But since then, development finance institutions have broadened significantly the scope of climate finance beyond just the mitigation aspects. In many ways, one is on risk mitigation standpoint, of course. More or less, all development finance institutions have developed a kind of rating able to measure or assess the potential negative impacts of their actions, especially on a social standpoint. At Proparco level, we have that, and of course, we are trying to measure and to maximize the positive impacts and to mitigate the negative ones. Then we are financing or investing in more and more projects with a dual approach and a dual impact approach. For instance, we recently financed Acciona, which is a major infra player so it was a sustainability-linked loan, so it's kind of innovative way. The use of proceeds was to finance the Line 6 of the subway of Sao Paulo, but at the same time, for assessing the KPIs of the sustainability-linked loan, it was linked to social aspects, connecting people to solar energy, connecting people to proper water supply. So it's kind of new. And eventually, I want to say that DFIs have raised awareness that the fight against climate change could be successful only if we are dealing with the social aspects of that. So through a more holistic approach and action plan, this is what we are trying to do through developing what we call nature-based solution, embracing a more comprehensive scope of action. And also, just one example, recently, it was our mother company on the public side. They financed a 400 million euro loan to the South African government to finance only the social aspect of the ZP transition, not the green transition, the social aspects, because, people have to accept the transition if we want that to be successful.
And feel included as well, definitely. A last word. The motto of Change Now is with action comes hope. What is one concrete step that DFIs and PDBs should consider to accelerate the money available for projects in low-income countries?
Yeah, I would insist on maybe two things. First one being advocating for a new asset class. Be it blended finance asset class or being development asset class, the recognition of what MDBs or DFIs are doing as a risk mitigation factor is not enough setup. So we have to advocate towards regulators that what we are doing is a major mitigation factor on a risk point of view, and I think it will have a major impact. So this is the first thing, especially to develop private capital mobilization. The second thing is innovation. This is, I think, the next frontier for DFIs. Of course, we already innovate, but we have to go even further in that direction to justify our additionality. Innovation can be going to new markets, new geographies, to finance new technologies, and of course, financial innovations as well. This is clearly where DFIs have to concentrate now.
Françoise, thank you so much. I think as a conclusion to accelerate the propelling force of DFIs and including Proparco, we can retain partnerships, the link with local communities, with local bodies, with local associations, with local authorities, with local actors, and not pretending that we can do everything from such very nice places as Grand Palais. The second thing that I also remember is the importance of analyzing risk in a way that is more objective and taking it into account and not minimizing it. Thank you for these wise words. Thank you, Françoise.
Thank you very much. Thank you.
So, our next panel, because we heard the point of view of a prominent DFI, now up to private investors to come and share their perspective. So please join me on stage. 3 fantastic panelists and experts in the field. Please, Paola, Florence, yes, Christine. Welcome, welcome, welcome. Okay. Is the mic working?
Hello. Hello, hello.
Paola, just press that. Works? Okay, cool.
Can you hear us?
Yes.
It works?
Yes.
Yes, okay.
So welcome. I hope that the first discussion inspired you to be even more effective and let's say quick in the deployment of private money into these important projects. So we have approximately a bit more than 20 minutes, so a bit less than what was expected, but that's fine. We'll adapt to cover many points and to cover the diversity of your expertise, your geographies, and your asset class as well. So I will start with a question, just for the audience to understand. I will ask the same question to our 3 panelists because they're very diverse perspectives, and I believe it would be worthwhile to hear what they have to say, each and every one of them, on a similar topic. So first off, 10 years after the Paris Accords and countless COPs where private investors made commitments to expand public and private cooperation, we're still lagging behind. That's unfortunately the reality, and especially in low-income countries. Based on your experience, can you tell us what is missing for private investors to step up and follow the lead of DFIs in substantial amounts? What would you need to see more of, or possibly to see less of? Paola.
I will speak from the point of view of a venture capital and private equity fund investor. So this is my limited area, just to set the scene. And I will speak also about investment in emerging markets, because that's the area where I have been active. What is missing, in my point of view, is more leadership from DFIs, more leadership to do exactly what our friend from Proparco was telling us. We need to be more innovative, not only in the instruments and the blending we're using. We need to go for more fragile economies and places where impact is really going to make a change and move the needle. We need to be faster in taking investment decisions, and we really need to set, to attract, be able to catalyze this private investment.
Paola, I love the fierce answer. Can you tell us from where, what is your vantage point?
My vantage point is I work with a lot of first-time fund managers in emerging market, young people who are very, very innovative in trying to find solutions for all the problems that they are facing. And it is extremely difficult for first-time market players, like first-time fund managers, to raise the funds. And usually, the money, the anchor investments, don't come from DFIs, they come from the private sector. What I see is that often the private sector leads the way, and once you have traction from the private sector, the DFIs come in. I have even seen funds where the catalytic layer of first loss was provided by foundations of corporates from the private sector, and then the DFIs came into the senior layer, taking advantage of that first loss.
Thank you, Paola. Florence.
Yes. Hi, everyone. Very happy to be here. So I'm talking from the point of view of a private investor, AXA, an insurance investor. I'm head of responsible investment for the group. And as a global insurer, AXA has a very long-term focus, so it's very interested in sustainability, resilience. And as such, we have set targets for some years. Our targets to finance climate transition is for 5 billion a year. We also have a target more on the social side, which is to improve community resilience, and the target is over 500 million a year. Last year we did 1.3 billion. And those investments include investment in emerging markets. So we are invested in emerging markets. We have about 30 billion in our balance sheet on emerging markets. And we are open to do more. But what we need is attractive projects that fit our risk return appetite. And oftentimes, as you mentioned, Françoise, there are a mismatch in the risk that we can take and the risk profile of investment in emerging markets, and that's why we need DFIs to step in. And we believe that we can do more, especially with blended finance. We can do more at a better pace and at a bigger scale. And for example, we are in the Insurance Development Forum, and we are part of the Infrastructure Task Force. And in this task force, the idea is to gather insurance investors to follow our risk tolerance and find attractive projects for that, and attractive projects that have an impact for the resilience of communities, so infrastructure, hospital, waste management system, water system, bridges, transportation, and the objective is to replicate those investments. And we use blended finance again, so that's very important, and we expect to mobilize about 1 billion euro in partnership with BlackRock for this initiative. And of course, DFIs are invited to participate in this infrastructure initiative for emerging markets.
Thank you, Florence.
Thank you, Amen. Good morning, everyone. It's a pleasure to be here. My experience has been running an investor network that is actually registered in Singapore but operates globally across 25 cities and scaling rapidly. We're hoping to be in 40 cities by the end of this year. In the network, we have a combination of sovereigns, DFIs, private equity, family offices, angel investors. So we really have a big, broad range of investors that are focused on climate. We're called Investors for Climate. What I feel is missing from my experience and from my point of view is definitely more trust and transparency, not just in the pipeline, but also in the performance. So the DFIs are definitely taking a leadership role, strategic leadership role that help give credibility to early investments. We definitely appreciate, very inspired by the talk of Françoise early on. But for the private community, I feel the bridge is still not there. And I think there's a lack of a couple of things. More opportunities for co-investments, structured co-investments, blended finance. You touched on blended finance. I think the problem there I see from my vantage point, especially with the private investment community, is that we haven't really customized the language to really appeal to their appetite. So when you look at Singapore, for example, I'm sure many of you have been to Singapore. I've been based there for 20 years. Pre-pandemic, we had about 150 family offices based in Singapore. Today, we have almost 2,000 family offices. And so our role with Investors for Climate is to listen really hard about what are these families investing in? How did they make their money? Was it in real estate, shipping, cement? What's in their portfolio? Are they looking for more catalytic opportunities? Are they looking for deep tech technologies to de-risk their assets? So we see that role, and then that's when we bring in the opportunities. We pull in the sovereigns, we pull in the DFIs, we talk to private investors and try to match them with what is missing, and not just in early stage, but in later stages as well.
Thank you, Christine. If you keep the mic, what is one concrete situation where you witnessed a positive cooperation at play between public and private investors? And what lesson can you help us draw from it.
Absolutely. So I have a great example, actually, and I really had front stage row when I saw this happening in Singapore. So Singapore has recently become more of a food tech hub. Those who are familiar with investing in food technologies, and this is drawn particularly because of the insecurity that we've had with the supplying food. Now, many of you have probably been to Singapore, 6 million people on a small island. We import about 90 to 95% of our food. So during the pandemic, that vulnerability was made very apparent. As our borders were tightening, we couldn't get some of the proteins, eggs, chickens from around the region. And I saw happening very fast a shift in public capital being directed to develop this food technology, investing in plant-based, cultivated meat, vertical agriculture, farming, etc. So we were seeing our sovereigns. We have 2 sovereign wealth funds in Singapore, GIC, Temasek, investing heavily in this space. EDB, Economic Development Board of Singapore, was very much a partner in developing this ecosystem. The Singapore Food Agency was doing the research to de-risk these opportunities, and they allowed many more startups in this space to come and set up in Singapore in line with their 30% by 2030 plan of producing as much as 30% in Singapore. The private capital followed very fast. And I saw that myself because I was a consultant with one of the food tech unicorns from San Francisco that was launching cultivated meat. We raised millions and millions of dollars through this opportunity. And the lesson that it taught me is that, and I know it's a small ecosystem,
and
but
it's not a low-income country, but
it's
yes.
not a low-income country. We're a small case study in this sense. But what I saw was that when governments obviously are very clear and create the opportunities for this ecosystem, not just in investing, but storytelling, policy, it can work. It worked in the food tech system, but it could be applied in global climate as well around the world.
Thank you, Christine. Florence.
Yes, maybe I can mention a success story. This is not a new one, but this is a very important one of the IFC MCPP program. This was launched over 10 years ago, and we invested in 2017. NCPP is a program between the World Bank Group, IFC, and private money. And this is a program of managed co-lending portfolio platform. And there were several rounds of this program. We invested in 2017. And now, more than 10 years later, when it started, which was before 2017, over 15 billion euro were mobilized by the IFC, so a very successful program. And I would say the success factors there were that the IFC saw a need that needed to be filled, and they designed the program to appeal private investors, to appeal their risk appetite by using innovative blending finance, and that's again an important point. They also leveraged on their local network to find interesting projects, and they only came to fill the gaps, to pave the way for private money to come in places where they would not have naturally come. So that's an interesting example.
Thank you. Paola.
Yes. The example I will mention is one that I know well. It's Boost Africa. In 2018, we were starting to see from sub-Saharan Africa the first venture capital funds emerging. I'm not talking South Africa, but the other countries of sub-Saharan Africa. And we thought we need to invest in them. I have been working 24 years with the European Investment Bank. I forgot to say it. And so from the European Investment Bank, we said, how can we actually invest in first-time teams in sub-Saharan Africa doing venture capital in very early stage startups? And the important thing of why this project took off is because we said, okay, it takes a village. We need to cooperate among DFIs. So we wrote to all the DFIs, and Africa Development Bank actually answered and said, let's do it. Second thing, within the DFI, my team, we needed to say to the European Investment Bank, let's do very small, very risky, very time-consuming projects. That's all a bank hates. So how do we bring the institution to do this, well, they needed some mitigations. They needed a mitigation in the form of a first loss. So we went to Brussels to the Commission, and that's where we got the first loss. And this first loss, we decided, and this is very important, to put it at the level of the funds so that it would mitigate the risk of all the investors, private sector, DFI, whoever invests in the fund will get a risk mitigation. And the third thing, which was really key to have this whole industry of venture capital take off in sub-Saharan Africa, was that even though we were working only with one other DFIs because the others didn't immediately want to, we were meeting with all the operational people in the DFIs twice a year to report on progress and exchange views. And working together actually attracted them to many funds. And now we have really a collaboration. Boost 2 is taking off. The private sector is investing, and so that's
very clear. I would like to leave some time for the last question, which is a bit tricky, and I would like to leave you enough time to answer it. Some private players expect DFIs to hedge most of their financial risk, and you mentioned the first loss tranches or guarantees, while keeping most of the financial returns. At the same time, there is an increasing pressure coming from public opinion on DFI's budget use, sometimes to require more financial returns or more impact done locally, not far away from the capital holders. Or for Proparco, impact done in France. For FMO, impact done in the Netherlands. So although emerging and low-income countries are seen as too risky, hardly investable by many private investors, the certain social and environmental costs of inaction is hard to fathom, including in rich countries. So how do you navigate this equation, impact versus financial return, risky now versus tomorrow certain, here versus there, from your respective vantage points? I know it's a difficult question, but I think it's important that our audience hears what you think about this. Thank you.
Thank you for that question, Imen. It's an important one for sure, and it is a complex answer. I think for us at Investors for Climate, we believe that the sooner we understand that the cost of inaction is greater than the cost of investing in innovation, the better it is. And that's certainly something that we've been focusing on. The risk appetite of our investors, of course, vary greatly, because as I mentioned, it's a very diverse group of investors. But we try, in terms of leadership, I have a co-founder, both her and I are really trying to instill as much as we can the influence that we need to look at the social and environmental impact. I spent 13 years of my career working in philanthropy, so I have that lens. I'm still operating 2 nonprofits in parallel. So in my perfect world, we look at that, that combination when we propose investment opportunities to our syndicate. And actually, the very first one we proposed was exactly that. It was more of a catalytic investment. It was a company called Coast for Sea, one of the Earthshot Prize finalists. It operates in the country where I was born, in the Philippines, working with seaweed farmers. I was very proud to put it forward, but it was not an easy sell. I had many comments like, well, this is not VC returns, but look at the social impact, look at the environmental impact, and ultimately, in a perfect world, we need to look at those values very clearly, because if we don't invest this way longer term, we will pay the cost. I'm completely convinced in it, because I've been working at the grassroots level in philanthropy for so long, and I know it needs more capital. And so we keep passionately advocating for this, really looking to quantify the social impact, the environmental impact, future-proofing. Our world is what we need to focus on. And I always say that, honestly, and this is what I see our role at Investors for Climate is, the best networking that we do together as a community is about making other people more successful. And so we're pushing for that.
Thank you. Florence.
Yes, as you mentioned, Imen, there are important needs that are not covered. Some will have to be covered by public money around public goods, and this cannot be filled by private money, but others, and a big part can be partly funded by private money. But I would say that as private investor, we still need attractive projects, both from a financial and impact perspective. And today we still have a lack of data, lack of track record, lack of regulatory stability in some places, and that's where we expect DFIs to play a more active role, to be, risk taker, to pave the way for private investors. It doesn't mean that we need concessional capital forever, but we need these risk mitigation measures to be able to deploy at scale, to deploy replicable initiatives, and to invest massively and to make emerging markets an investment place for private money.
Thank you, Florence. Paola.
Yes. Well, I have one thing that I think is really important. DFIs and everyone needs to invest in more projects which are women-founded and women-led, because there you're sure you will get impact. At least from my vantage point, that's what I see. Secondly, I will talk to a point that our colleague in Proparco was mentioning, which is true. We need a new asset class for DFIs that is recognized, and that is something along the lines of regenerative finance. We need to see that financial profit is not what we're going after. We're going after regenerating the human and natural capital in the world. And to do this, and then try to move towards financial sustainability, but not start with the profit idea, because then we will end up competing with the private sector instead of leading the way towards more impact. And there is urgency, and there is scale is needed. So we need to accelerate the pace and lead the way, be bolder, and go into really open the way for more impactful projects.
Thank you. Thank you, ladies. I think, I hope the audience heard how both exciting and difficult the challenge was in this very limited time. Thank you for your expertise, and
Thank you, Imen.
thank you, Imen. To the next panel. Thank you. Okay, are you still awake? Can you still hear us? Yes? Now to the trailblazers. Where is Leah? Where is my second panelist? Where is she? Yes, there she is, Christina and Leah. Welcome, welcome. Hello, hello, hello. Yes. Listen, we mentioned many obstacles. We mentioned the old ways. We mentioned the impossibilities. Now is the time to mention action, to mention dedication, to discuss call to actions in bold and global ways. So thank you. Yes, 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 yes. Okay, take your seats. Thank you, Leah, for making it to the Grand Palais. Yes,
thank you.
It works. Thank you, Christina.
Thank you.
We have a little more than 20 minutes to discuss your amazing initiatives and to hear about your particular vantage points, which are, collective and collaborative experts. So, you both have a long experience of building collectives. Thank you. To mobilize investors of all kinds on a global scale. At GSG Impact, at Convergence. You know the tears and the joys and the nitty-gritty of public-private cooperation. 10 years after the Paris Accords, and I keep on repeating it because time is running out, so 10 years, it's already been 10 years. It's high time we collectively stopped small-scale experiments and went full force to deploy the amounts of money beneficiaries called for, and rightly so. So what lessons, in your opinion, should we pay attention to? Leah.
Sure, I'm happy to be here. Thank you so much. It's lovely to see friends and colleagues. So I work in an area called blended finance. I think, and I would imagine most of you in the room have heard of blended finance. In particular, oversee an accelerator within Convergence. Convergence exists to solve the problem in terms of the cooperation between public and private partners to mobilize more private capital. So there are kind of a number, if I look back on the past 10 years of Convergence's existence, there are some really key lessons that I would take forward. One is consortium-based building. And so what do I mean by that? Ultimately, we have looked at a number of blended finance structures, some of which have worked, some of which haven't, and most of which have come from a consortium-based lens. I think a really great example would be BlackRock's private equity firm that ultimately started from a question: how does private equity solve for climate finance? From some design funding that was received through Convergence, later some other testing, BlackRock ended up launching a $600 million fund to address climate issues. That was done through a consortium of UN partners along with Aligned Capital consulting group. So these consortiums can come together quite effectively. The other lesson that's big and bold is make it demand-led, make it market-led. One thing we're seeing that's very popular in Asia right now is this leaning into nature-based solutions, nature credits. That's mainly for corporate supply chains. It's not thinking through the lens of a traditional institutional investor, but the corporates are leaning into this model. They've subscribed to larger climate goals. So within the context of blended finance, these supply chains are going greener, they're going greener faster, and ultimately this is a demand-led approach. The last thing that I would mention in terms of what is truly igniting change is don't be afraid to lead as an individual, but drive as a herd. So what do I mean by that? We at Convergence oftentimes throw out problem statements around blended finance. So for example, can blended finance solve for the financing gap for nature-based solutions? Yes or no? I would say 3-4 years ago, we really didn't know, but we put out the problem statement, and lo and behold, there was quite a bit of activity, business models that were supporting nature-based solutions, nature credit. So we led as an individual, but we only started to curate a herd, which now represents a pretty large investing interest pool in advancing nature-based solutions. So those are 3 core areas and lessons I would say can really help move things forward.
Christina.
Thank you, Leah, for this, because it's a perfect bridge to introducing what we do at GSG Impact, and I really like this idea of going together as a herd. So just for those who don't know GSG Impact is a UK charity. Our mission is very simple. It's to build impact economies all around the world. And so today we represent 46 countries that have joined us on this mission. And how do we do that? We help local ecosystems to create new national institutions that are inclusive and representative of the local ecosystems. The demand side, the intermediaries, the supply side, the market builders, so academic institutions, consultancies, and so on, and very importantly, in partnership with government. And so these new national institutions, we call them national partners, and they work on 2 essential levers for change. One, policy, so policy changes, new rules, new regulations, working with government to create the best possible incentives for capital to flow towards impact, and also creating or disseminating new financial instruments or financial vehicles that may be missing in the market. So creating fund of funds, disseminating sustainability-linked loans, for example. I mean, there is a ton of those. So our approach is really systemic and holistic, and that's why I like what you just described, because it's not just moving one aspect of the ecosystem forward. It's working with the entire ecosystem
at the same time.
At the same time, because if you leave one player behind, then it's hard to get them to catch up. It's probably slower, but it's it's the best possible way to go forward, because by creating these local institutions, they are there to last. They are there to be finding the right solutions for themselves in the next 10, 15, 20, 30 years. And so that's what we do. We help these ecosystems to create those changes locally. And now I just want to maybe reflect on your question about the lessons learned. There's a ton of lessons learned, but I want to focus on something that we just recently are finishing. We're about to publish a report that is the result of a 1-year working group that we co-hosted with 3 DFIs, BII, Norfund, and USDFC. And this working group was meant to look at what are the success factors for private capital mobilization for SMEs in emerging markets. I just want to repeat, SMEs in emerging markets. So we think that there is, I mean, we've been talking about the financial issue of access, right? You know, what kind of access, how can we improve the access for finance for SMEs in emerging markets for so long, but still, we're still talking about it. So how do we really move forward on this issue? And so we looked at where does capital mobilization happen. What we found is that it doesn't happen where we think it happens, at the co-investment level. That's how usually DFIs measure mobilization, at co-investment level. However, it does happen in downstream of their investments. So let me give you two examples quickly. KCB Bank, thanks to those investments from DFIs, has multiplied or is projected to multiply by 500 their SME lending portfolio from 2017 to 2027, thanks to those DFI investments and some TA. And similarly, a French investor called Investisseurs et Partenaires, through their EPDEV fund, has a 6-to-1 ratio, leverage ratio of attracting additional private capital. So those are really success stories. And so the lesson learned here, and I'm going to contradict to some extent Françoise Lombard, is to replicate and scale what works. That's the lesson learned. We need to be much better at replicating and scaling what works. We have a ton of tools that really work, and it's not about finding new things, it's about replicating and scaling what works.
Thank you. So in your experience, what is missing for public-private investments to catalyze serious money? You answered it a bit, Christina, in a fashion that is actually impactful, but also not financially predatory against beneficiaries, or, and we have to say it, self-serving for the country where the DFIs come from, or for the corporate brand or private investors.
No, thank you. It's a great question, and oftentimes it's important to look through these investments as any sort of just transition, even outside of the context of climate. So, and Christine and I did not plan this, but her last statement is a perfect segue to my what's missing. We happen to work quite a bit outside this context, so perhaps that's why. But with respect to what's missing, replicability is actually what's missing. And when I say replicability, I don't mean necessarily replicability of what we know, but more of replicability of what's worked and what's been successful. And I'm speaking hopefully to a lot of investors in the room, and you should be concerned about primarily one thing, exits. An exit can come through two many different ways. One is recapitalization, the other is obviously buybacks, et cetera, acquisition. And I'd like to speak to just two examples that are both clear examples of success in blended finance, but yet lack replicability. And there's a clear blueprint. One in Asia is the Tropical Landscape Financing Fund. It's a partnership between UN agencies and a private equity firm in the region. Ultimately, it was to take rubber plantations, make them more sustainable, make them holistic, community-based, ultimately generate a margin, real products that could be entered into a global supply chain. Fast forward, those plantations and that entire transaction was exited to Michelin, a publicly held company. We heard a little bit about this exit, but not a lot. And I think that's a very important example to entice investors into the entire life cycle of what it means to invest in a blended finance fund, and then that blended finance fund go on to actually seek successful exits. Another example of replicability that we're seeing very little of in terms of what's missing are the blue bond. Convergence, we provided the initial design funding for the Debt for Nature swap in Belize, which most of you, I think, are familiar with. It's a classic structure whereby TNC, the Nature Conservancy, bought the debt off the balance sheet of Belize, refinanced it, longer tenor, lower cost. Any sort of savings went towards conservation at the country level. I'm not going to say that it was easy to do by any means, but I would say that it's replicable at this point in time. So that's a core thing of what's missing. The other aspect, I think, what's missing as we move forward is in blended finance, we often focus too much on closing the financing gap. And suddenly the financing gap to meet the SDGs, it's gone from 3 3 trillion to 4 trillion. I think most recently now it's 6 trillion. And then our next statement is always, well, let's look to institutional investors to help us close that financing gap. And I feel like what's missing in that conversation is, instead, let's look at what are the bite-sized opportunities that institutional investors can take. And I say that because then we're not moving massive amounts of capital in unfair ways into markets, but yet looking, instead of the aggregate volume of dollars, we're looking at the aggregate volume of transactions. And investors learn through transactions. So this unfair, somewhat weighted pressure we put on investors to close that gap is somewhat missing without the tools, toolkits, and transaction-level information to do so. The last thing I'll mention in terms of what's missing are non-traditional investors. Non-traditional investors tend to take a more sensitive approach to the aspects of what you're saying. We fortunately are seeing a lot more family offices talk to one another in terms of driving both the agendas of their respective communities, but also the agendas of their asset managers. So ensuring that their asset managers, whether it's UBS Optimus or others, are actually designing blended finance solutions that can make the change that's required. And then some other big players that we're finally seeing in the market, but we need to see more of, is Amundi, SocGen, others that are truly developing large-scale, multi-billion-dollar blended finance vehicles, but they oftentimes, of the handful that have done it, only do it once, and maybe, I think about 35% actually do it twice. So what's missing is my job to actually talk to them on a more detailed level in terms of understanding why that's not happening more so.
Christina, very briefly, so that we can have enough time for your 2 calls to action.
Well, my call to action is short, so. Yeah, what's missing? A ton of things are missing, but I would focus on 2 key aspects. One is support for local and locally led initiatives. I mean, we need to bring them at the front and center to what we are doing at all points in time. Oftentimes, we favor what we know, who we know, and don't kind of go the extra step of looking at what is happening in the countries where we're trying to create change. And so let me tell you a little bit about what 3 examples of what our national partners are doing in Ghana, Zambia, and Nigeria. So they are designing structures and vehicles that really answer their specific market gaps with a holistic ecosystem building approach. So Ghana is doing a 75 million fund of fund with 30% of catalytic capital aimed at attracting local pension funds. Now, how is that great? It's great because, first of all, it's built with impact at the heart of it from the get-go, with specific impacts that they want to achieve in terms of agriculture, climate change, women, and all of the different SDGs that they want to target. The second is that by attracting local pension funds, it unlocks local capital, which usually is just invested in treasury bonds in the country. So bringing in new investors, and also it mitigates the currency risks that we usually are always talking about. And so it's really a smarter use and a much more catalytic use of catalytic capital, and it has scale, it has national scale. So this is a great example. Now, Zambia is doing something similar but quite different because they're working with their central bank on a credit guarantee scheme. So the central bank has committed 180 million. Again, so you know, if we think that countries are poor, etc., no, they have capital, governments are willing to invest, and if we bring them the right kind of support and structuring, it's a perfect, you know, we're talking of public-private partnerships. It's a great example of a public-private partnership, and this is aimed to create the right kind of incentives for the local banks to on-lend to SMEs, especially in the agricultural value chain, which is a huge value chain in Zambia. So these are 2 great examples. I mean, Nigeria is doing also something similar, but they are on the earliest stage, so I won't go there. But these are 3 concrete examples of locally led, locally designed, super advanced and very relevant market building initiatives, which are there also for investors to see and look at.
Thank you. I said it earlier, I will say it again. Change Now motto is with action comes hope. And if I may say, with collective and resolute action comes hope. What is your call to action today for us?
Yes, thank you. I think that's a wonderful way to end our conversation. So within our accelerator, within Convergence, we have had the opportunity over the past almost 10 years to fund and support the early stage advancement of 70 plus blended finance solutions. Those 70 plus have gone on to mobilize about $2 billion of additional capital, half of which is commercial capital. That's clearly not enough, and 10 years is a long time. So my call to action is acceleration, and to join us on this movement and pathway of acceleration. Convergence, when we launched, we probably did a good job sharing the message, building the data, introducing the network, supporting the ecosystem. But we're on a pathway for much more advanced acceleration, and we're doing so, and this will be discussed more broadly at G7, but we're doing so with a G7 donor country that's actually going to invest in the accelerator to support institutional investors who really want to dig into scope, develop, launch, and build blended finance solutions. And we'll be awarding not only grant funding, but boot camp support, skill building, access to intelligence, access to networks, et cetera, specifically designed and geared for asset manager and fund managers. This is very exciting. We're flipping things on its head. We're talking now to those who need to push out or have the opportunity to push out the billions and structure accordingly. So join me on this movement of acceleration. That would be my call to action.
So fund managers, institutional investors, go and talk to Leah.
Yes.
In a nutshell.
Looking to seek out blended finance.
Thank you. Christina.
The most important thing from my perspective is to move, and you will have got the message, I think, through this short session, is to move from transaction-based or project-based approaches to systemic approaches. Things don't happen in a vacuum. And we have to look at what's happening in the ecosystem, and especially, so this is my call to action for donors, is to fund the connectors, the ecosystem builders, the risk takers who are looking at building the ecosystem. And I want to give a small shout out to our national partner in France, who actually brought together this, this session, this panel today, because FAIR is the secretariat of our national partner in France. So that's a great example again. The second is for the shareholders of DFIs, because DFIs, they can only do as much as they're being told. For the shareholders of DFIs, to change the mandate of DFIs, allow them to take more risk, allow them to play at below commercial level, because most of the time they're competing with commercial investors. To release more data on the performance of their investments. This is not happening today, and this is a really, really important thing to move forward for investors to have more data. And then for investors to look at what a risk it really is. I invite investors to travel to the countries, to better know the countries, and realize that actually the investments that they are about to make are much less risky, much probably, than some of the investments that they are making in developed markets, because the risk perception is not actually the same as the risk in the countries. And something really easy to do, which is not happening today, but hopefully will happen soon, is for donors or investors to work with credit rating agencies and work with the credit rating agencies to help them grade investments that are not just the sovereign investments, but go more granular in the investable opportunities and rate them better in the countries. So that's one example. And yeah, for all of us, this is about cooperation, this is about collaboration. We have to do it as if our lives depend on it, because they do. So it's for all of us to step up, take action, go out and try to do the extra step that it takes to collaborate with other organizations and other partners on this journey.
Christina, Leah, thank you. I think the way I receive your message is that private investors and DFI shouldn't reinvent the wheel, and also rely on other experts' experience, either locally or on technical experience as well, to accept the wealth of experience and build from it, and not start over and over, to be able to achieve impact at scale, hopefully. Thank you so much. Thank you for joining us. Thank you for your attention. And I believe we have a networking session here. Okay, just right here. Thank you so much.